Welcome to Fred's Financial Planning Workshops. Today we're going to be covering the second of two workshops on retirement planning. I'm Fred Smith with the Silicon Valley chapter of the AAII, and I've given you my email address down here in case you have any questions or comments you'd like to make. It's fred.svaii@gmail.com. I've also given you our local chapter website because these slides are available there for download if you choose to do so. We start off with our standard disclaimer. This is the sixth of our financial planning workshops. We started off with a couple on investment planning and portfolio management and the like. Then we covered taxes. And now we're doing retirement planning, and then we will, next time we will cover risk management, otherwise known as insurance, with an emphasis on annuities, long-term care, and umbrella policies, such forms of insurance. And that will be followed by Social Security and Medicare, which are two topics that are probably more complicated than most people realize, and we're dedicating a whole session to those. And then we will end up the series with estate planning, looking at probate and executor or trustee duties and the like. I'm not an attorney, so I'm going to look at this more from the practical point of view of an executor or trustee's responsibilities, rather than a bunch of legal ideas. So today we're going to be looking, as I said, at retirement planning. We'll start off with a look at Bengal's 4% rule, which most people are somewhat familiar with, but may not understand how it was derived. We look at variations on that, and then we'll switch to a different technique for drawing down your portfolio based on the IRS required minimum distribution tables. And then we'll end up looking at bucket strategies and some variations on the traditional equity glide path. This comment at the bottom sums it all up in my mind. I have no idea who made it, but basically they're saying that most people spend more time planning a 2-week vacation than they do on their retirement. How true. So let's look at Bengal. Bengal used the Ibbotson data from 1926 up to 1992. His original paper was published, I believe, in 1994. So the latest data he had available was the full year up through the end of 1992. And he looked at common stocks with an annual growth rate of about 10.3%. And he used treasuries in his portfolio, for a diversified portfolio, with a growth rate of 5.1% and an average annual inflation of 3% per annum. So if you take a 60-40% diversified portfolio, that works out at an average return of 8.2%. And if you if you take the account of the 3% inflation, then you get a real return after adjusting for inflation of about 5.2% per annum. So up to Bengal's time, most folks say, well, if you get 5.2% per annum, real return, it should be perfectly okay to pull 5% per annum out of that portfolio, and you should not run into any problems. I think Bengal showed that wasn't necessarily the case. So we'll look at a little experiment. We're going to see what happens if in practice you're pulling money out of the portfolio, whether it is indeed safe to use a 5% withdrawal rate. So we start off by assuming, just for simplicity's sake, that you have a $1 million portfolio on the 1st of January 1980, and that you invest this portfolio 60% in stocks and 40% in intermediate bonds, the way Bengal did, and you rebalance it annually. And we start off withdrawing 4% per annum from this portfolio, starting in the beginning of 1980. In other words, a $40,000 withdrawal for 1980. And you would make a withdrawal each year of this $40,000, except that you bump it up by 3% each year to account for inflation. So we want to see how long does that portfolio last, and then we'll try it with some different withdrawal rates to see what makes sense. So for a simple diversified portfolio, we're looking at 60% stocks. The S&P 500 is the easiest reference for that, and I use the Vanguard S&P 500 index fund, the VFINX, because the data on that is available back through 1980 up to the end of December in 2020, and the compound annual growth rate over that period is 11.1%. Then we add in 40% bonds, 5-year treasuries, and over the same time period, that's got an annual compound rate of return of 5.2%. So the simplified portfolio should give a 9.1% return over the 1980 through 2020 time period. And then if you allow for 3% annual inflation, that should give a 6.1% real growth rate. And just to put things in perspective, if you were making no withdrawals at all, that 1 million portfolio over the 41 years grows to roughly 35 million. So there's a long time period and a fairly decent annual growth rate. But with no withdrawals, it would end up at $35 million. But we want to look and see what happens when you do make withdrawals. So here's the S&P 500 over that time period. Starting in 1980 was a good year. 1981 was down a little bit, but most of them in general, you've got a bunch of good years until you reach the 2000, 2001, 2002 bear market, and that was a little bit of a crunch. And then there's some good years, and then of course there's 2008, which was a serious down year. I believe it was down about 37%. Negative return for that year, and that's followed by a bunch more good years. So that's what the stock side of the portfolio looks like, and the fixed income side for the 5-year treasuries. The early 80s, you got some really decent returns from 5-year treasuries, up into double digits, and it's been declining ever since. And for the last decade or more, you've been down in the low single-digit area. Obviously not a great return from 5-year treasuries for the last few years. So what does our 60% stock, 40% bond portfolio look like? Well, as you'd expect, the early years look great from 1980. The actual portfolio, mixing in the fixed income, the treasuries, got rid of some of the smaller negative returns on the stock side of it, but the 2000, 2001, 2002 bear market still breaks through, although the negative returns aren't nearly as bad as they were before. And 2008 goes negative for the portfolio, just beyond 21%, which is an improvement, obviously, over where it had been for the stock alone. And then again, the subsequent years have been pretty much okay. There was one other down year, I think it was 2018, where it was a slight negative for the portfolio, but nothing serious. So that's what the portfolio looks like. When you start making withdrawals, how does your $1 million initial portfolio behave over the years as you're pulling out the $40,000 for the first year, and then adjusting it for inflation for subsequent years? Well, we start off with $1 million, and if you use the 4% withdrawal rate, it goes sky high immediately. I have no idea where it would end up eventually. It's obviously not going to get to the full 35 million, but it's certainly going to get up into double-digit $1 million portfolio pretty quickly. Even with the 6% rate, the portfolio grows fairly rapidly. With an 8% rate shown here in blue, the portfolio grows initially and then decays as you'd expect as you're making higher and higher withdrawals because of the inflation adjustment, and you get roughly 35, 36 years from before it runs out of steam. So that's at 8%. Now, if you push to 10%, now we have a problem, because the portfolio is depleted in just over 20 years. That's probably not acceptable for most people. But it looks like this 8% portfolio would be perfectly okay for most people. You're getting a 35-year lifespan from your retirement portfolio is not all bad. If you retired at age 65, that would take you out to age 100 and would probably be acceptable for most people at 8%. So the question is, why did Bengal come up with a 4% number? What's the difference? What's going on here? So starting in 1980 was actually a pretty favorable time to start. We have to look to see what happens if you're going to start your withdrawals at a less favorable time. What happens if you were to retire on the 1st of January 2000 and have 3 years of bear market to look at before you started to make any significant upside? So what we've done is rearrange the sequence of the returns to start with the years from 2000 through 2020, and then move the 1980 through 1990 years to the back end of the sequence, and we'll see what happens to the portfolio when we do this. Now, you should note immediately that without any withdrawals, you've still got the same 9.1% compound annual growth rate over the time period. That's the same regards what the sequence is, and the standard deviation and all those measures are still the same. They're not changed by the fact that you've rearranged the sequence of the returns. But as soon as you start making withdrawals from it, then the results do in fact show a difference. So we want to see what does that difference look like. So this is what the portfolio looks like when you've rearranged it. We're starting off in year 2000. We've got the 3 down years there, followed by some good years, and then the 2008 bear market, and then a bunch of good years. So that's what the rearranged sequence of returns looks like for the portfolio. And here's what the actual portfolio value looks like over the years. Starting in 2000, we start off with at the $1 million, but there's a real crunch occurs in those early years, and even with the years between from 2004 up to 2007, we regain some of that, but then the 2008 crunch comes in and kills the portfolio a little bit again before it starts taking off in a positive direction and for real. But this green one is with a 2% growth rate or withdrawal rate, and obviously that looks very, very safe, as does a 3% withdrawal rate. But 4%, this blue one here, runs out of steam in just about just less than 30 years, and the 5% red one runs out of steam at less than 20 years. So 5% is obviously a problem for most people if you happen to start your retirement at a non-favorable time. But the blue one at 4% is pretty darn close and probably acceptable to most people, and that's where Bengal got his 4% number from. And he was looking at the worst case over the time periods that he did his research on, and he figured that 4%, you do a lot better under a lot of conditions, but under worst case conditions, 4% may be as good as you can hope for. So we'll look at that in a little more detail. The obvious lesson that we learn from this is that it's not good enough to just look at the averages over the years, even including inflation. You've got to look at what happened in the actual sequence year by year by year. Performance in the early years is critical, important because of the sequence of return risk. Now, if you happen to have a serious down market, in the early years, coupled with inflation, that can cause a serious problem. And Michael Kitces did some work on this area as well. Bengal basically said that the first few years after you retire is critical, and that most people say, well, maybe the first 5 years is the important thing after you retire. But Kitces looked at what happens for the few years prior to retirement, and he said the effect is just as bad. So the bottom line in all of this is that you have roughly a 10-year window, five years before and 5 years after your retirement date. And in that 10-year window, if you have a serious bear market, it could potentially spell trouble for you, and you need to be very, very careful about your withdrawal rates. So to look at Bengen's actual research, the paper was published, I think, in October 1994. And as I said before, he was using, he had complete data up through 1992. And his portfolio in his paper was a 50% common stock and 50% intermediate treasuries rebalanced annually. And we'll see later that the asset allocation between stocks and bonds was not critical. Anywhere between 50 and 75%, he was fairly happy with. But this is what he used in his paper, and he had a 3% withdrawal rate, or he looked at that first, and then he also had a 3% per annum inflation. And he evaluated the portfolio over 30-year periods. The first one would be 1926 through 1955, and then followed by 1927 through 56, and so on. So he had a whole bunch of 30-year periods that he looked at and to determine which ones were safe with various withdrawal rates and which ones weren't. So he started off looking at 3% withdrawal rate, and then looked at 4, 5, and 6% withdrawal rates. His actual results were, that he published back in 1994, were that with 3% withdrawal rate, the portfolio, even under worst case conditions, always lasted at least 50 years. So that was obviously safe over, for the years that, for the history that he was looking at. At a 4% withdrawal rate, the portfolio lasted 35 years. You figure that's probably safe for most people. And that was why he chose 4%, as the safe withdrawal rate that he recommended. At 5%, the portfolio ran out at 20 years, and at 6% at 17 years. So he figured those were just not acceptable for most people. It's interesting that these numbers are driven by the worst case period that he looked at, and it's interesting to my mind to note that the worst years that really determined these numbers were actually 1966. This is in order of severity. 1966 was the worst year to ever start your retirement. If you retired on January the 1st, 1966, that's the worst you could possibly have done over the time period of history that he looked at, from 1926 onwards, followed by some of the other mid 1960 years, then 1937, and finally 1939, 1940. It's interesting to note that 1929, that crash doesn't even appear on the worst 10 years, and that's mostly because of that inflation was pretty low at that time. The reason these years are the most severe are mostly driven by inflation driving up your withdrawal dollar amount every year. So what is Bengen's 4% rule? As he defined it, he said, if you set up your portfolio with 50% to 75% in equities and the balance in intermediate treasuries, you can withdraw 4% each year and then bump that up for inflation. And under those conditions, most portfolios will last over 50 years. But if you happen to hit a worst case time period as in the years that he studied, your worst case portfolio should last for 35 years. Now, as I said, Bengal's paper was published in 1994, the original paper, and prior to that, people had not taken the sequence of return risk into account at all. It wasn't a concept that most financial planners looked at. But Bengal's 1994 paper changed folks' thinking on that. There's a whole ton of work done since then. But Bengal himself, a decade later, re-looked at his data, and he obviously had an extra 10 years of data to look at now. And he said, well, what happens if you change your portfolio and put some small caps in there? And this is the percentages that for the asset allocation that he used. And he was able to show that under these conditions, you'd be able to bump your initial withdrawal rate up to 4.5%. In 2012, I guess we'd just come off the last decade returns, and people were a little more pessimistic. Bengal himself commented that you might want to be careful if your withdrawal rate exceeds the initial rate by 25% or more, and start taking some action to safeguard your portfolio. He didn't spell out the details, but he just raised it as a warning flag. In 1998, there was a study done at, I think it was Trinity College in Texas. It's known as the Trinity study. They did similar research to Bengal's 1994 paper, and they showed that if they're using high-grade corporate bonds instead of intermediate treasuries, and they used the Iverson data extended through 1995, a couple of years, 3 years more than Bengal had available. And then instead of looking at what was the worst case return, they calculated what they call a portfolio success rate for various withdrawal rates. They figured that they looked at all of the time periods available, and they calculated the percentage of time that the portfolio ended up positive. In other words, that you didn't deplete it totally, and the balance of that is obviously the failure rate. And their portfolio had 75% stocks and 25% bonds, and again they adjusted for inflation and took withdrawals in the same manner as Bengal had set up. So with their data, they were able to show that with a 3% withdrawal rate, they had 100% success. The portfolio never was depleted. With a 4% with initial withdrawal rate, the 98% of the time the portfolio ended up positive, but there was a finite risk, albeit a small 2% risk, that the portfolio might be depleted. With 5% withdrawal rate, then the failure rate increased, in this case to 17%. And finally, when you get out to 7% withdrawal rate, you got roughly a 50-50 chance of ending up the period with a positive portfolio or having it depleted before you get there. So again, this kind of confirms confirms Bengal's data. 4% looks like a reasonable starting point. There's some small risk, but it seems manageable. Craig Israelson published a paper in 2016 where he did a somewhat similar experiment. He set up two portfolios: a conservative portfolio with 15% large cap and 10% small cap stocks, and then a fixed income of 75%, mostly in bonds with some cash. And then he also had a moderate portfolio with a larger allocation to the equities, 40% large cap stocks and 25% small cap. We've got 65% stock and 35% bonds, which is probably closer to what most people think of as a diversified portfolio in retirement. And he looked at various, the effects of various inflation rates from 0% all the way through to 6%. So what does his data look like? Well, he's showing that with the probability of success with the 3% inflation rate, with the 3% withdrawal rate, the conservative, well, both portfolios are safe, with a 3% withdrawal rate. With a 4% withdrawal rate, the conservative portfolio is still positive at the end of the period, with 93% of the time. But the moderate portfolio does better with 98% of the time. And you can see for the moderate portfolio, this kind of mirrors some of the data that we've been looking at earlier. With 5%, your success rate drops to 91%, goes down to 71% with a 7% withdrawal rate. For the conservative portfolio, you get into trouble very quickly with the higher rates. I think that one of the messages, the takeaway from this, I think, is that building a conservative portfolio for the long term, you've got to be very, very careful, because if you're overly cautious, overly conservative, you can get into trouble. This portfolio was heavily weighted on the fixed income. It didn't, there were not enough stocks in there to keep up with inflation. So the moderate portfolio looks like a more reasonable bet, from Israelson's data. Gayton and Klinger published a paper in 2006 which looks at this a little differently. They defined the need as a 40-year longevity, because with folks retiring earlier, 40 years is not an unreasonable time span. And they set up 3 portfolio management rules. The first rule was what they call, the portfolio management determines which of the assets that you make your annual withdrawals from. And they say you want to avoid taking the withdrawals from any equity funds that are negative for that time period, and under those conditions consider taking the withdrawal from the fixed income side of the portfolio. They set up an inflation rule that says regardless of what the inflation actually goes up to, they're going to cap the increase in the withdrawal amount at 6%. They never allow the withdrawal annual increase to go beyond 6%, regardless of what inflation does. And they also set up guardrails to limit the amount of the withdrawal rate under certain conditions. If if the withdrawal that you're doing went beyond a certain limit, then they set up a plus or minus 20% guardrail to limit how much you'd actually withdraw. You never go beyond that. And if you're willing to live by these 3 rules and make adjustments as you go along for changes in the circumstances, they figure it's okay to start with the withdrawal rate somewhere in the region of 5.2 to 6.2%. And this is obviously a pretty high starting point, based on the Bengal data and the other data that we've looked at up to now. But if you want to start in this range, you need to be prepared to make adjustments, to monitor what's happening to your portfolio as you go along, and make adjustments, usually on limiting or reducing your withdrawal rate if things start to look a little bit bad. Michael Kitces looked at this from a more, what I would consider perhaps a more practical perspective. He said most people starting out with the 4% rule die with a final portfolio that's passed on to the heirs far greater than the original value. And we saw that on the experiment that I showed at the very beginning. For most people, 4% leaves you a ton of cash at the end of the 30, 35, 40-year period that gets passed on to the heirs. And this is obviously money that, had you known, you could have spent on your own lifestyle. So what Kitces suggests is that you start off with a conservative number. Something 4% is probably a good starting point. And under certain conditions, you can start bumping that up. For example, when you, as you get into your retirement, then you discover, well, I've gotten through the first few years without hitting a serious bear market, and my risk is a little bit lower here. So maybe it's okay to, got fewer years to run, and maybe it's okay to start pumping the withdrawal rate up a little bit. And he's saying that if your portfolio balance is ever greater than 50% higher than the original value, then you can bump up your the withdrawal cash, including all of the cost of living allowances, by 10%. But he does suggest you only want to do that 10% upwards ratchet, a maximum of once every third year. But it's a way of being safe initially, picking a safe value initially, and then watching what's happening to your portfolio. And if it's growing at a rate, that's higher than necessary to guarantee the remaining years will be positive, then you can start ratcheting it up a little bit. The other side of the coin is Fow and Doken. They published a paper in 2015 which says, hey guys, all of this data that everybody's looking at up to now is based on historic data, and that may be dangerous because history was different then to what it is now and what it will probably be going forward. In essence, they're saying that the interest rates started off, if you go back to the 1980s, we're up in double digits, and we're now down to very low interest rates, and that may last for some time. So the return from the fixed income side of the portfolio may be lower for the decades going forward than it has been for the past decades. And they're also saying that the stock market valuation is pretty high at this point in time. Well, this is back in 2015, but it's still true. The Shiller Cape Index, the price earnings for 10 years is pretty high. So if the stock market is pretty high to start with, it may not have as high a return going forward for the future decades as was the case in the past. And they also wanted to look at a 40-year horizon for the reasons we discussed before. So with their conditions, they figured that a 4% withdrawal rate from a portfolio that's got 75% stock in it has only a 73% success rate. There's a 27% possibility of failure, which may not be acceptable to some folks. They said even with the 2% withdrawal rate, there's still a small chance, albeit a 10% chance of failure. So they're a little more pessimistic going forward. The argument real simply is that the next couple of decades may be very different than the past decades in which all of this data has been based, and you need to be careful before you jump into any of those, making your decision on what withdrawal rate to use. Bill Sharp looked at this a little bit differently. His argument was that that there should only be two things that you're looking at that are important in determining how much you're going to withdraw from your account. It should depend on how much is currently in the account and how long you're likely to need it. And based on that argument, he says that all of the Bengal type rules that say pull 3%, 4%, 5%, whatever it is initially, and then adjust it for inflation for all the future years, does not satisfy rule number one. Most of the rules, well, I guess with the exception of Geaton and Flinger, don't allow you to get in and modify the withdrawal rate is set based on your first year, on the portfolio value of the first year, and normally does not look at the portfolio value for subsequent years. So Bill Sharp had a problem with that concept. So if you look at all the Bengal type rules, you wind up with a cash flow that's determined by the initial portfolio value, and you're not looking at it, on a year by year basis. That was the point that Bill Sharp had problems with. Some other issues. The Bengen's rules essentially give you a fixed real cash flow rate. You pull out the same cash flow after inflation, and adjusting for inflation year after year after year. It's that fixed number at at the 4% of the initial portfolio. That may not be what you want. That's interesting in that it gives you the a stable cash flow year after year, but most folks, in their earlier go-go years would, like to have, maybe want to spend a higher cash flow, and then, have a lower cash flow in the intermediate period. And then when you get into the later years, maybe it needs to go back high again, because of medical costs and so on. So having a fixed constant real cash flow may not be optimum. The other thing with Bengen's rules is that in periods of high inflation, it tends to unravel and get into serious trouble. If you're bumping up your cash flow by the inflation amount year after year, that can be a big problem. If we do run into high inflation at any point during the retirement time. Bengen assumes that the historical worst case sequence of returns, is the worst case. That's possibly true, probably true. In fact, that he looked at 1926 onwards. That's a long time period with a couple of with a World War I or World War II period in there, and a couple of other serious wars and periods of high inflation and low inflation and so on. So it is in fact a fairly diverse history set, but it may not really truly be the worst case. And the other thing, as we said, with a lot of the Bengen rules, is you're leaving serious dollars on the table for your heirs in most cases. If you don't happen to be unfortunate enough to hit a tough bear market starting point, you're likely to leave big dollars on the table, for your heirs, and that may not be what you necessarily wanted to plan on. So you might have you might be able to improve your lifestyle if you could adjust a little bit more as you go through it and avoid this problem. Insofar as it is a problem, some people may not see that as a problem. So what are some of the other techniques or strategies that people use besides the Bengen type rules? Well, I wanted to spend a little time on the required minimum distribution method, the RMD method that Sun and Webb published in 2012. What they're in essence saying is you go to the IRS tables that they publish for the required minimum distribution from your IRA account and use those as withdrawal rates or withdrawal rates, spending rates during retirement. It's the IRS never ever intended it to be used that way, but Sun and Webb figured that it's pretty darn close to what many people might regard as an optimum spending path. I'll show you the numbers in a minute. The advantages of the Sun and Webb strategy were that, first of all, it's easy to follow. You just go to the IRS tables, pull the percentage that they publish for the RMD from those tables, apply it to your current value of your portfolio, and you're done. There's nothing else to calculate. It turns out that it's fairly conservative in its withdrawal rate, so that's good for most people. It doesn't force you to go to any specific asset allocation. It doesn't assume 50% stocks, 50% bonds, or any other number, and it responds to the current market value as Bill Sharp preferred. The disadvantages are that it gives you different withdrawals year after year. They're up, they're down, and in a good market, a good stock market, the withdrawal for that year may be high, but if you hit a bear market for a year or two, the withdrawal rate for that time is going to be a lot lower, and this may be tough to deal with. And again, the withdrawals sequence may not be tailored to your actual needs. It may not necessarily work out that it's higher in the early years and typical needs higher in the early years, dropping off a little as you age and slow down a bit, and possibly going back up again for medical needs at the end. So, even with this RMD method, it takes no account of trying to track what your actual needs are. I've shown here what the actual table 3 from the IRS table looks like. I don't need to go into the details, but at age 70, it starts you off at 3.6% and then increases the percentage as you age, all the way up to almost 16% at age 100. The table actually goes out to 115, I think, but that was beyond what I thought was necessary to show here. Now, the IRS does have a new table. There's a new table that has been published, but I don't think it goes into effect until next year, 2022. And the numbers have changed a little bit. They're a little more favorable, but the concept will still be the same. So you can see that you start off with numbers not too different to what Bengal was talking about or any of the other folks were talking about, and then increasing the percentage year after year, but you're applying that percentage to the actual portfolio value. Now, I want to look quickly at what happens when you compare the RMD method with Bengal's withdrawals. For Bengal, we started off with a $1 million portfolio. We started off with $40,000, the 4% $40,000, and bumped it up by the 3% each year. And it goes out to at age after 30 years, at age 100, it would be up to just about $100,000. But it's a steady, predictable number. If you look at what happens with the RMD method under these conditions, you're pulling out a higher dollar number each year than you are with Bengal, and it actually gets pretty darn high. And then there's a drop off during at the end of the 30-year period. But even here, it ends up with after 30 years with a $200,000 withdrawal, twice Bengal's withdrawal rates. So this looks very favorable in terms of suggesting what you might want to be able to pull out of your portfolio under these conditions, under the favorable conditions. So what happened? What does the portfolio look like in this case? Well, Bengal's portfolio was growing and growing and growing, because you're pulling that same number out each year and not adjusting it for the various portfolio values as the market swings up and down. And over a 30-year period under these conditions, he ended up with almost 8 times the amount of the portfolio that he started with. For the RMD withdrawals, they track Bengal in the portfolio value tracks Bengal's in the early years, but then it starts to fall behind because you're pulling a higher and higher percentage each year, and then that's coming from driven by the actual value of the portfolio, and you wind up at the end of the 30-year period with a portfolio value that's comparable to what you started. So that's the price that you pay for the higher withdrawals that the RMD method gives you over the 30-year period. But maybe this is closer to what folks want. Maybe they don't necessarily want a significantly higher portfolio to pass on to your heirs. But all of this is under the favorable conditions. What happens if we look at the unfavorable conditions for somebody retiring, on the 1st of January 2000? Well, again, Bengal doesn't know the difference in this. He starts off with his $40,000 and chugs away in a predictable manner up to $100,000, same as before. But with the RMD method, when you run into 2000, 2001, 2002 bear market, the portfolio value drops, and therefore the amount that you're pulling out of it drops, and you get another downdraft in 2008. It's actually over 15 years before the withdrawal rate from the RMD matches or exceeds the withdrawal rate suggested on the Bengal strategy. After that, when you hit the good years, your portfolio value starts to go up, so your withdrawal amount starts to go up. and you wind up pretty comfortable over here. But the price you pay is that for over a decade, you're pulling out less money, less actual cash withdrawal than you would with Bengen's 4% plus inflation strategy. So that's what the withdrawal rate looks like. What does the portfolio look like? Well, for Bengen, we started off with the 1 million, and as you're pulling out, regardless of what the market is doing, you're pulling out your 4% plus inflation each year, and the portfolio runs out of steam in about just less than 30 years. That it's kind of what we saw before. Whereas with the RMD method, again, you're starting off about the same, but the portfolio takes a little dip, and then it goes back up again, it takes another dip. But during these early years, you're pulling out less, so you're doing less damage to your portfolio. And then when the good years hit, you can recover a little bit. So the bottom line is that you end up with a significant, after 30 years, you've still got something like $700,000 in your portfolio. It's just a little below your starting point, but you could obviously continue for more years at this rate. It's not going to crash and burn the next year. But the price for ending up here was, as we saw earlier, to take lower withdrawals for over a decade during the bad years in order to have enough of the portfolio to survive and recover during the good years. I want to talk real quickly about bucket strategies and changing topics here a little bit. There's been a lot of work done. I guess Harold Davensky in Florida was the first guy to start doing work in this area. And Christine Benz at Morningstar has published a whole ton of papers in this as well. But the concept basically is that you may want to split your portfolio into two or more buckets and manage them sort of separately. Bucket one, this is regardless of how much you're actually pulling out. I mean, this is a shift in our topics here. Bucket one is going to be used for your actual living expenses, pulling dollars out of that month by month to live on. So you're going to have a short-term thinking in terms of it, and the assets in that bucket are going to be fairly stable assets, CDs and T-bills, money market funds, and the like. But the purpose of bucket one is to provide your living expenses when you need them. So you want minimal risk here. Bucket two, main purpose of bucket two is to provide the growth that you need on the long term and to at least protect from inflation. So you're going to wind up with a diversified portfolio here that's probably fairly heavy in stocks and not too much in fixed income because you're managing it on a long-term basis. So a simple strategy might be suggest that you withdraw your living expenses from bucket one, and then each year you transfer whatever percentage you think of, 3%, 4%, 5%, whatever number you settle on, from bucket two to bucket one. And those transfers don't necessarily mean that you have to sell stock in bucket one to do it. First of all, the diversified portfolio will be spinning off some interest and dividends, so you can use those. If you're doing rebalancing on an annual basis, you can use some of the proceeds of that for the transfer. If you're doing tax loss harvesting, maybe some of the proceedings from that can go into bucket one. And finally, if you don't have enough dollars in all of this to cover the 3 to 5% that you need, you may eventually have to sell some of the equities. In practice, most folks prefer to go with, or many folks prefer to go with a 3-bucket strategy, where bucket one is short term, 1 to 2 years, and again, really safe investing. Bucket two is an intermediate bucket, 2 to 10 years. Pick a number anywhere in there that you're comfortable with. And there you have somewhat higher risk, but not too much. So you might have bond ladder, short to intermediate term bonds and so on, maybe even some high quality value stocks, dividend paying stocks. And then bucket 3 is the long-term bucket for 10 years or greater. And that one you'll have your diversified portfolio fairly heavy in stocks. What I'm showing you here is my attempt at what I call a funnel view. I'm not that great with graphics. So these red asterisks here are meant to represent a funnel, and you've got cash in this funnel that's dripping out the bottom. And you start off with you've got your long-term diversified portfolio at the top, as we discussed, in 10 years or more, that's feeding dollars from that drops down into your intermediate portfolio. And that could be typically 5 years, and dollars dripping from that one into the short term 1 year, and then finally coming out for your monthly expenses. It's all the same data as before, but it's just a different concept in viewing it. So maybe if you want to go with a fixed percentage, you could set up a mechanical approach where you might have 3% to 5% annually transferred from your long-term bucket into the intermediate bucket. And then if the intermediate bucket is let's just say it's a 5-year bucket, then you'll transfer 20% of that each year into bucket 1, and then withdraw your monthly expenses from bucket 1. It's easy to set up. But it may just require that you occasionally have to sell from bucket 3 in a down market. When I say it's easy to implement, that's true in theory, certainly, and it's true if you have a fairly simple portfolio strategy. But it may get a little complicated if you have 3 or 4 different accounts at different brokerage houses, some for your IRA accounts, maybe you have a taxable account at Schwab and stuff like that. And if you have accounts scattered over a number of different sites, then it may be a little more difficult to track all of this. But you can understand the principle of it, of what we're trying to accomplish doing it. So how do you actually set it up? The first thing you got to do is determine what paycheck you need every month. And you take your living expenses, you need to do a budget and find out what your living expenses are going to be and how much of that is covered by fixed income already, mainly Social Security, if you're lucky enough to have a pension from any sources. And so you can determine that the shortfall here needs to come from your retirement account. Set up a strategy that you're comfortable with and a rate that you're comfortable with. Create the buckets and fund them and document the plan and monitor it regularly, because the world changes. Well, 2020 showed us how quickly the world can change and the environment can change. So monitor it at least on an annual basis. And all of these bucket strategies require you to have a short-term account that's anywhere from 2 years up to 3 or 4 or 5 years. And with today's interest rates, a lot of folks would regard the money in that account as dead money and not earning any significant return. And one of the suggestions that I've seen, this is Wade Pfau in particular has done a lot of work in this area, is to use a HECM, a home equity conversion mortgage, reverse mortgage. If you set up a line of credit with that, you can use that to fund the transfers into bucket 1 that are needed to avoid having to sell some equity, some stocks in the middle of a bear market. It costs a significant number of dollars to set up a home, and they're all set up a home equity conversion mortgage, and there are all sorts of FHA restrictions that you have to meet to do it. But in a lot of cases, it may be worth considering doing it if you're taking a significant hit on the earnings of your so-called dead money. The concept here is that if you're in a bear market, you can go to the HECM to get the funds that you need, to transfer to bucket one, and you can then repay that in a bull market. When the market goes up again, you can pay off the heck. You can pull money out of a reverse mortgage in a number of different styles. You can pull it out as a lump sum or as an annuity, but one of the options to pull it out is as a line of credit, and that's what I'm talking about here. Going to look at equity glide paths. The traditional number said you put your age in fixed income. In other words, if you're age 25, you put 25% of your portfolio into fixed income, and the balance goes in equities. Most folks today consider that too conservative, and they probably put less in here and more there, all the way down to 0 and 100%, maybe 5% and 95% early. But the principle here is that as you age all the way through your life, the fixed income portion of it increases and the equity portion of it decreases, and you go more and more conservative as you age all the way through from your initial career, retirement, say in your mid-60s somewhere, to the end of retirement, maybe in your 90s or so on. So this is a linear drop in your equity side of it, and a linear growth in your fixed income. Recent research shows that may not necessarily be the optimum way to go. First of all, there's the risk of the financial risk of living for 30 or 40 years in retirement. It's great to do it, but not if your portfolio runs out before you do. You've got sequence of return risk to worry about, and you've got at retirement, you want to have your lowest allocation to stocks. The argument in general says that the riskiest date in your whole life, from the point of view of your retirement portfolio and the protection of it and the value of it, is on the day you retire. On that day, you've got a long time frame ahead of you that the portfolio has to fund, but you've walked away from the ability to fix it, with a paycheck coming in regularly if things turn against you a little bit, or even if you make an error. And you've got the potential, like we talked about before, of sequence of return risk. So on the day you retire, it is a dangerous time. Fowler and Kitces argued that since that's the worst, the riskiest day of your life, that it makes sense after you retire and some of the risk is taken off the table. Maybe you've avoided, a few years later, avoided the sequence of return risk. You've got less years to project out that you need to have the portfolio remain good for, that under those conditions, you might want to start bumping your glide path up a little bit. And they're saying that you early in your career that you want it to be high. Nobody disputes that. They're saying that on retirement day, they're dropping all the way down on what they regard as your most vulnerable day to something in the region of 20 to 40%. And then after you can retire, it can start growing again back up into the 60 to 80% range. Dave Blanchett doesn't dispute most of this, except he's saying that after retirement, you may want to look at other things that affect the market environment, maybe the Shiller's Cape Index or something like that, to determine what the glide path should be. But the data shows that this most often gives you a better outcome, a higher ending value in your portfolio. But there is a risk. There is a finite, albeit hopefully small risk, that if things turn against you later, that this higher value could hurt you. But it's if you do it carefully, it's a risk that can be managed and be small. So this is a quick look at the black is the traditional glide path, starting at high and going all the way down to the end of retirement. The red is what Kitces and Fowler had suggested, and then Blanchett says that somewhere in here, he agrees that somewhere in here makes sense, that you don't want to go down here. but that you need to look at this point at your environment to determine, how steep you go back up. There's a fundamental question that we all need to ask ourselves, I guess, in looking at this. It's somewhat subjective. There's no right answer or wrong answer, but there are in essence two approaches to funding your retirement portfolio. There's the probability-based approach, and there's the safety-first approach. With the probability-based approach, you build a diversified portfolio that could be 60% stocks and 40% bonds, or whatever you're comfortable with, and you withdraw whatever percentage you want from that. And if you're careful, you can get some decent total return from your diversified portfolio, but there is a finite risk that the market will move against you, and that the portfolio may get into trouble, may run out before you do. Hopefully it's a small risk, they're certainly in the single digit area, but it may be unlikely to happen. But as we saw with Bengal and some of the other risky, or so-called risky portfolios. When I say risky, I'm talking about in the economic sense, where there is the possibility that the portfolio could run into a bear market. Some folks sleep a lot better at nighttime with the safety first approach. They don't want to accept a 2% failure risk or something here, or a 5%, whatever the number works out to be. They prefer to have all of their essential expenses, the roof over your head and the food on your table, covered with risk-free investments that are there regardless of what the market does. And ways to do this would be, from your Social Security income, perhaps a bond ladder. If necessary, they would consider buying an immediate annuity or a deferred annuity to make up the shortfall, so that they've always got month after month after month enough guaranteed income coming in to cover their essential expenses. And whatever is left over after this that's in their retirement account, they can use that for discretionary expenses. And what that really means in practice is that when the market's doing well, they can go on vacations around the world or whatever they want. But if the market turns against them for a couple of years, they wind up deferring some of these discretionary expenses to a later time. What you're really doing is looking at the current lifestyle versus safety. It's the old eat well versus sleep well decision, and it's different for different people. There's no right answer, but you probably need to be fairly clear on whether you're in this group or in this group. Mixing them may be okay, but you need to be aware of what you're doing, I guess is what I'm saying. Don't let it happen by default, and think about it some. With the safety first lifestyle, you're potentially setting a withdrawal rate that could be too high and necessitate you reducing it to run out of money, or you could be picking too low a number and having a surplus that you leave on the table for your heirs that may not necessarily be what you intend. The old adage here that I keep coming back to is know thyself. If you go back to the very early sessions that we looked at on investing, we discussed having a personal investor profile, an investment policy statement where you're defining who you are and how you want to manage your account and how you're going to do it. And you need to make sure that those truly represent what you are, and that will sort of drive where you go on the eat well, sleep well curve. Parting thoughts. There is no rule to satisfy, there's no equation that's going to give you an optimum withdrawal stream from a retirement portfolio of volatile assets with an unknown expected returns over the next 30 or 40 years, actually for an indeterminate period. You don't know whether it's going to be 20 years, 35 years, 40 years, whatever it is. So there's no point in going to retirement planning software and cranking out numbers that give you withdrawal rates, to 5 significant digits and so on. There are so many, not just known unknowns in the future, but unknown unknowns that you want to get a good approximation and look at it on an annual basis, but don't put a ton of work into sharpening your pencil too much for this. The future may be very, very different to the past. We already know that interest rates, for the last 40 years have been declining. The likelihood is that they're going to go back up again in the future, but who knows? The comment I'd make here is that there's no such thing as a safe withdrawal rate. It only means safe as far as we can tell. Safe insofar as the future looks like the past. And if the future doesn't look like the past, the safety may be a little ephemeral. I like Kitz's approach to be conservative initially, and then you get more aggressive later as you get older and you weather some of the storms, and there's less risk involved. I'd also suggest that some folks may want to pass some of the risk onto an insurance company by considering an annuity. We'll be talking about that in the next workshop. But the bottom line is stay flexible and review your plan on a regular basis. It's important to just check probably annually what's still the same and what's changed. I've given you a bunch of reading material here. This is Bengen's original paper and some other stuff from Bengen. A lot of the other strategies that would look like Geaton and Klinger's paper is in here, Craig Israelson. A whole bunch of reading material here. Wade Pfau, Michael Kitz's, Christine Benz. So for anybody who wants to dig deeper, it's all here. I've given you some websites that may be useful. One in particular I might want to point you to is the Living to 100 website. If you plug in a bunch of personal data about your age and your health and your family history and all of that, it will give you an estimate of what their likely retirement period will be. Obviously no guarantees with it, but it gives you a ballpark number and it's useful. And we end up with our mandatory cartoon. I like Leroy. He's got a good mindset. Leroy has a certain lifestyle he wants to maintain. That's it for this workshop. I thank you for watching and hope to see you next time.